Hi, good morning, everybody, and welcome to Nedgroup Investments Multi-Manager's second webinar of the year. And I welcome you from a nice, cool and cold Cape Town. We have a number of dialers and webinar attendees from all over the country, and welcome to everybody. And I hope you're keeping warm and safe and healthy. We've really got a great lineup of speakers today for the next hour and a half or so. And so I will straight away go into a few of my slides. I'm going to really try and just set the scene for our speakers of the day. So I'm just going to open up the presentation and we will get going. So just in terms of the speakers for today in the lineup, we're going to start off with Nicky Weimar from Nedbank's Chief Economist. She will be setting the scene in terms of 5 actions that government needs to make in terms of getting the economy going. We're then going to hand over to Seugnet de Villiers, a member of the multi-manager team, who's going to talk a little bit about behavioral finance and do clients have enough risk within their portfolios. We then hand over to Iain, fund manager of the Nedgroup Balanced and Managed Fund. He will be looking more at the domestic investment markets, specifically focusing on South African retailers and some banking stocks. And we then hand over to Professor Piet Naudé. He has spoken before at some of our Nedgroup presentations, and he will be looking really at the impact of COVID on the South African schooling system and the opening up of schools in terms of the current environment, and I guess the ethics and morals behind opening schools up versus managing the health benefits and risks on the other hand. And finally, we have Terry Smith, who will be dialing into us actually from Mauritius, and he is the fund manager and founder of Fundsmith, and he will be really focusing on the FAANGs stocks. Is that a bubble waiting to burst? And we know that the FAANGs have really been skyrocketing over the last 12 months or so. Just to set the scene, I think a little bit, what has happened over the last quarter in terms of actual markets. And if we take a look at this slide and really look at the square that I've highlighted in red, if we take the South African equity market, it's up 11.5% over the last quarter. South African property is up 4% and bonds and cash roughly flat, up about 1% or so. If we look at the bottom part in gray, that is the global markets measured in US dollars. And we'll see there the MSCI All Country World Index is up around about 16% in dollars, listed property up 9%, and global bonds up 3.7%. So really across all asset classes and both South African and global markets, it's been a very strong quarter and past 3 months. If we look now actually at the middle section, I'm sure some people won't actually be aware the South African rand has actually strengthened by 7% or so over the last 3 months or so. So that is the South African, the returns of global markets, but measured in rands, and you'll see there equities up 9%, property up 2% in rand terms, with bonds and cash actually giving you negative rand returns. This is the currency, South African currency over the last 5 years or so. We see as of this morning, I went and checked, we're currently trading at around about 1660, 1658 to the dollar, which is certainly an improvement of around 1950 or so that we were in the peak of the crisis in March or so. So you'll see there on the right-hand side, the graph, how the rand has come back in the last couple of months. And it's certainly one of the most liquid emerging market currencies that we have. And you can see that the rand is certainly pretty volatile currency relative to the dollar over time. This, I think, is quite an important slide, and this one really looks at the real returns across asset classes. So what we have done here is we take the actual return that the various asset classes have given us and we strip inflation out of the return to give us the real return. And this is really the return that as an investor we need to achieve to grow our wealth, because we need to grow our wealth over and above whatever the inflation rate is. And if we look really, I guess, at the navy blue block, which is the 10-year real returns, we do also have the 3 and 5 year real returns in this graph, but let's focus on the longer term of 10 years. Starting on the left-hand side, we'll see there that South African equities over the last 10 years has given you about 5.5% real return, which is below the long-term average of about 6.5 to 7%. So it's not bad, but not fantastic. South African listed property the last decade has been absolutely terrible. It's given you a negative 2% real return per year for the last 10 years. Having said that, the previous decade was actually an extremely strong decade. South African bonds and cash has given you 3% and 1% real, which is roughly in line with their long-term averages. And then towards the right-hand side of the graph, which is the global returns measured in rands, they've given us pretty strong and decent real returns, with a lot of that returns, virtually half of those returns, coming actually from rand weakness. Looking at the South African stock market, this really plots year to date. So for the first 8 months or so of the year, the returns of some of the top 10 best performing and the worst 10 performing shares on the stock market. So if we really start off perhaps on the right hand side on the best performing stocks, these are the 10 best shares year to date, and they're really dominated by the gold mining and platinum shares. So we see here Goldfields, Anglo American, Anglo Gold, Northern Platinum, Ronet, etc., all up. Goldfields up 131%, being the best performing share, and otherwise up around about between 50 to 100%. The other standout shares, I guess, is Naspers and Prosus, which are one of the same business. One listed locally, one listed in offshore, and that has been a strong performer. It dominates the index in terms of the South African stock market, and along with other technology shares has performed really well. On the left-hand side, which is our top or our worst 10 performing shares, again dominated by the financial institutions. We see all the banks there: RMB, Nedbank, Absa, Capitec, Old Mutual, First Rand, down between 40 to 50% year to date. And just in the last couple of weeks, the banking companies have come out with their results, and we see headline earnings per share are down between 50 and 70% across all of the banking stocks. On the bottom, we see Mr. Price, one of the big retailers in South Africa, down close to 40%. So retailers, banking stocks have really taken a knock year to date. In terms of the South African economy, hasn't been a great quarter. The results just came out this week. South African economy contracted by 40% for quarter 2 of this year, which is the worst quarterly contraction in over 30 years. We're expecting the South African economy to contract by between 8 to 10% for the year of 2020, which would be the largest calendar year contraction in over 100 years or so. Interest rates in South Africa remain positive, at least, as opposed to the rest of the world, where many countries are in 0 to negative interest rates. South Africa, you're getting around about 4.5–5% on your money market. Inflation's about 2.5 to 3. So you're having a real return of around 2% on your cash, which is certainly better than in many other countries. Inflation figures for July just came out this week. It was at 3.2%, which is right on the bottom end of the government's target of 3 to 6. And ironically, though, was a 45% month-on-month increase from June, where the figure was measured at 2.2%. and it's the biggest 1 month rise in inflation since February 2016. And we've spoken of the Rand. Interestingly enough, the Rand on Friday actually strengthened 2.8% against the dollar to 16.56, which was one of its strongest one-day moves in many years. Looking a bit more offshore now, I thought this was quite an interesting fact and slide. So this shows us Apple, unbelievable business. And on the left-hand side, you will see there the Apple share price. The company went public in 1980. It took 38 years to reach an unbelievable market cap of $1 trillion. And in less than 2 years, it's now doubled its market cap to $2 trillion. And in terms of its market cap of $2 trillion, it's now larger than the FTSE 100 companies in the UK, so your 100 biggest listed companies in the UK, as well as larger than the entire Russell 2000 index in America. So Apple has totally been flying. In terms of social media companies, and here I guess we're talking a little bit about the FAANGs, we came across this interesting slide also that really just shows you in terms of the number of monthly active users that are using these social media businesses and platforms. So there's about 7 billion people in the world, and Facebook has 2.6 billion active users every single month. WhatsApp has 2 billion, YouTube 2 billion, Messenger 1.3 billion. So virtually every 1 in 3 to every 1 in 2 people are on Facebook or WhatsApp every single month out of people in the entire world. And I guess this is why we've seen, and Terry Smith will talk to it in his presentation, why these FAANGs or tech companies have been absolutely flying over the course of the last couple of years. And last slide from my side, which we also thought was quite interesting, is just looking into the future of which countries are really going to be dominating the world and economies. So if we look at 2030, so 10 years from now, really China currently ranked #1 in the world as at 2017, holding on to that #1 ranking, but its GDP growing from $23 trillion to $64 trillion. So basically tripling its economic size over that 13-year period. India will be #2, the USA #3, those two countries swapping places over the next decade, and then the rest of the countries. I think it's quite interesting to just see that countries like Japan, Germany, which are, let's call it, the more first world developed economies, actually falling down the rankings from 4 and 5 to 9 and 10, and more your emerging type economies, Russia, Egypt, Brazil, Turkey, really growing in terms of their demographics, their economic output over the next decade or so. So hopefully that just sets the scene, I guess, for the speakers coming up in terms of South African stock market, banking stocks, retailers, as well as in terms of the global economy. So I'm now going to hand over to Nicky. So Nicky is really Nedbank's chief economist. She joined Nedbank in 2000. She's been with Nedbank for 20 years or so. And she's going to be talking through what she feels are the 5 key points that government needs to focus on to get our country on the right track. So Nicky, I hand over to you.
Hello, everybody. Yes, I've been with Nedbank, actually, just to correct that, since the beginning of time. So, you know, that's an extremely long period. So to start out with, yes, I was asked today to sort of identify 5 things very briefly. So the good news is the prophet of gloom is not going to be talking for a long period. 5 things I had to identify that I think government should do immediately that could potentially change the outcome for South Africa and put South Africa on a better footing to stage quite a strong recovery. So let's start with where we are now and have a look Sorry, I'm just trying to control my mouse here. And the first thing that I think needs doing, I certainly think that in the case of South Africa, if you just read the media, you look at social media, you look at the official press, you just listen to your neighbors and to your colleagues and to your friends, the one thing South Africans have had absolutely enough of is corruption. We have spent over a decade in a situation where corruption has flourished, where public funds have really been siphoned off to the benefit of a few politically connected individuals. And that has done an enormous amount of damage to our institutions, to our state-owned enterprises, which, remember, provides the bulk of our economic infrastructure. In the process, we are now sitting with a long-term burden being placed on taxpayers that in the case of South Africa is a very narrow tax base. So the burden falls disproportionately on a few. And the outcome of it has, of course, been economically very destructive. So I think if there's one thing government can absolutely do to make an enormous difference to the South African economy and to confidence and to send a strong signal out there that South Africa is actually on the right path, it is to root out corruption and restore accountability. And those two go together. You can't just talk about rooting out corruption. You have to make an example of those that are guilty. So for me, one of the biggest channels through which corruption occurs in South Africa, it's almost been legislated into the system, is the tender system. So I would think that very clearly, one of the things that absolutely needs to be a rule is that no government officials, families, or government employees' families can actually do business with government, and elected politicians' families can't do business with government. Now, often that's said, well, that's unfair. No, it's not. It's a rule all over the world. So if you want to work for government, that's one of the things you just have to accept. And then we need to bring back into the tender system things like price, quality, and of course the capacity to deliver. By removing price as a key criteria in terms of choosing or electing your tenders, you have basically opened government up for a tremendous amount of exploitation and a tremendous amount of corruption. And then finally, we need to actually hold someone accountable. We have more than enough evidence. The work has been done by the Zondo Commission. If you look at them today, they look absolutely exhausted. There are reels and reels of evidence. It's now up to the MPA to get their act together and actually go to court. So that's one key thing I would like to see. The other key thing, of course, is if we want to grow, we need to fix our electricity situation. We are here currently in a situation where this economy is probably going to contract by 8%, which is the steepest contraction we would have since the Great Depression. All right, so that's in the 1930s. And so the bottom line is that you cannot grow if you don't have electricity. And in this weak situation, Eskom cannot cope. Now, I've been to a presentation or hosted one in which Anton de Ruyter was talking about the consequences and Eskom's future path. And they are doing, essentially maintenance. But he pointed out that we are probably going to have to live with an increased chance of load shedding over stage 2 until we get to around November next year. Well, that just eliminates any possibility of a convincing recovery. So without reliable and cost-effective electricity, we simply cannot grow. We cannot have fixed investment. And if we can't have fixed investment, we can't create jobs. And from government's perspective, if you can't create jobs, you don't create taxpayers. So the bottom line is this is a trap we do need to solve. And the solution is open it up. Stop trying to protect monopolies, just open it up to competition. End of the story. And if there's a private firm that can provide electricity cost effectively, they will do so. And at the end of the day, you will have a better electricity market. The next thing that I kind of identified that matters tremendously, I think, and that has been a big factor in undermining really just confidence in the South African economy, both domestically and globally, is this notion of expropriation without compensation. So we've already changed the constitution, but it's not clear. It's not clear exactly what the implications of this is. There's an expropriation bill, but there are many contentious issues in that expropriation bill. What we need to do is to make it crystal clear what are the boundaries of expropriation without compensation. And we need to make it crystal clear that private property rights will be protected. If you look at this graph, I'm showing you house prices versus interest rates. You can see property prices have been stagnant and drifting sideways for an extended period of time. We have a situation in South Africa where property is probably cheaper than it's ever been. The value you can get is absolutely astounding for the price, and interest rates are at near record lows. Normally in a market where you have that sort of situation, it would be screaming, buy, upgrade your property, move into the house you enjoy or you've always dreamt of, and yet it's not happening. So why is it not happening? Again, it's policy, and that's creating so much uncertainty that your normal price and interest rate signals are not actually functioning and helping the economy to recover. Then our biggest challenge over the next decade, we're not going to get rid of this challenge in a hurry, is of course the fact that government's finances have deteriorated dramatically. Level 5 lockdown, which was bizarrely strict according to the Johns Hopkins University in the United States, the strictest lockdown in the whole world, right? The whole world. So we're very special. We win that prize. Unfortunately, the consequences for government and for this economy has been devastating. And the outcome, of course, is that government revenue will implode, and with the deterioration in the economy and with the need to deal with the virus, you are going to see, of course, a very sharp acceleration in government expenditure. And this is going to be the challenge in the years ahead. Government will have to bring this budget back in line with the size of the economy. The deficit is going to be close to 15%, or slightly over 15% of GDP this year. Then it's going to float around that 10% level for the next 2 years. So essentially, what can they do? Well, there's only two things they can do. Well, there are three things. They can grow the economy. If they follow this advice, it might just happen. Secondly, they have to cut government spending. Where do they have to start? They have to start at the public sector wage bill. This graph up here shows you employment in South Africa. The green line is in fact public sector employment. The red line is the poor private sector. You can see how big the public sector has become relative to the private sector. But remember, the private sector generates your final taxpayers. So how was that funded? We know now. It was funded through debt, okay, through a massive escalation in debt. Now, in a recession like this, you don't want to be retrenching people. But that means that you simply have to say to them, listen, we won't retrench you, but you have to also share a bit of the burden here. And that burden is perhaps that you don't take a pay increase, that you don't get a 13th check, and that you bring the public sector wage bill in terms of public sector wage increases under control. And you can see in the private sector, there's been tremendous austerity, but in the public sector, that's not been the case at all. It's just ran out of control, even during Ramaphosa's reign. So it's time that this been brought under control. Inflation is only 3.2%. Only a few months ago, we were talking about inflation of over 4.5%. We're now at 3.2%. Why do you have such an enormous acceleration in public sector pay? So this is going to be their challenge, and they're just going to have to face the unions down. This is a battle they absolutely have to win. The IMF financing that they've secured now, it comes with no conditionality and at a very, very favorable interest rate because it is emergency funding for COVID purposes specifically. It's going to help them fund this deficit, this gigantic, frightening deficit this year. But next year, we start all over again. So unless they actually make fundamental changes and they stick to their guns, all right, essentially, we're going to run into a funding problem again somewhere down the line. And then we might have to go to the IMF for 4 more budget assistance. And when we get to that point, you are going to have these changes imposed on you. It's going to be a lot harsher. It's going to be a lot more painful. So you might as well be preemptive and do it in a way that you can control it and you can minimize the damage. So that's one thing I would obviously want to see happen. The final thing that I think needs to be done is that we need to relook our regulation. It's been one of the most damaging elements of the South African economy. You've often heard businesses say we want policy certainty, policy certainty. Well, what do they mean? They mean things like the visa regulations. Now, we've made changes to that. We took forever to do that. They mean things like mining, the mining charter. And it's not just there. It really is in every single industry affecting South Africa. Red tape, regulation, very onerous. Your compliance cost alone is incredibly expensive. And a lot of this regulation has unintended consequences. It either raises the cost of undertaking investment in South Africa, or it adds to the risk, and therefore it undermines confidence in the economy. So I think a review of regulation needs to be done. There have been a few good ones done that were largely ignored, so go back to those, don't start from scratch. Add the new regulation to it, evaluate it, do a cost-benefit analysis. Ask yourself the question, does it serve a purpose? If it doesn't, because a lot of it doesn't, scrap it. If it does serve a purpose, then does it carry any unintended costs? Does it distort prices? Does it raise barriers to entry and undermine competition? Does it facilitate corruption? Does it raise the cost of investment to the private sector? Does it add to the risk premium? Does it increase an element of uncertainty that is incredibly off-putting to attracting both local and foreign capital and fixed investment in the process? If really the benefits outweigh the cost, try and minimize the cost. But if the cost outweigh the benefits, simply scrap it. It serves no purpose and start all over again. So those would be my 5 recommendations, my humble advice. And I think it would make an enormous difference to confidence, and it would prove to everybody in this country, to investors and to global investors, that South Africa is serious about restructuring.
Nicky, thank you so much for that. That was great. And I've got one little quick question for you. I am trying to keep on time, so we'll just keep it brief. But just obviously this week, just the day before yesterday, I think we saw the NEC meeting and the Integrity Commission, and President Ramaphosa going to go and sit in front of it, and their whole sort of decision now that if you're facing corruption, you need to step down from your role, etc. Do you think that that is going to help? I mean, is that sort of the first step in the right direction with corruption, do you think? And will that help build enough trust, I guess, with the South African public on that matter, or do they need to go much further than that?
No, I think it certainly is the first step in the right direction, but they can't stop there. I think firstly, the MPA has to take a lot of this evidence to court. People need to be charged. The trials need to start. And from government's perspective, for example, and from the ANC's perspective, if you are charged with corruption and say those charges come through, then we need to see somebody actually step down or be forced to be stepped down. Because we've often heard this, even during Zuma years. Zuma did a lot of speeches about fighting corruption at every angle. So we've been in that bizarre situation. We now actually need to see an example, and that's the only way that you are going to convince people you are serious.
Yep, I agree with you, and yeah, let's see what happens. And Nicky, thank you very much. I thought your 5 points were spot on, as I mentioned it to you, and I really hope that I think you sit on some of those forums that deal with business, government, etc., and I hope you will do that same presentation to them. They only need 15 minutes. So thank you very much for your time, and we look forward to having you back at our next webinar in a few months' time. So I'm going to now hand over to Seugnet de Villiers. Seugnet, is fortunately in my team. She's a great person, hard worker, very bright, and she has a particular interest in behavioral finance specifically, and spends quite a lot of time talking to clients, talking to advisors in terms of trying to improve their investment performance through correct financial behavior. And she will really be talking through, do clients have enough risk in their portfolios? Because once again, we see in March during the COVID crisis, when markets are falling, people's anxiety increases. They tend to move into cash and cash-like products, generally at the wrong time, and miss the up part of the market. So Seugne's got some quite nice information and slides on this. And so Seugnet, I hand over to you.
Great, thanks Trevor. And yes, as you said, I'm unfortunately in your team, even if you have to say so yourself. Right, my topic for today's discussion, do clients have enough risk, or let's call it growth assets like equity in their portfolios, I think is such an important question to be asking all clients at the moment, because actually over the last 5 years already, clients have definitely been de-risking their portfolios. Here I take a look at the total assets under management over the last 10 years of the 4 largest CISA categories, excluding the money market category. And this de-risking trend is very clear. So the first thing I want to highlight here is 10 years ago, the equity sector, so SA Equity General, was 37% of the assets under management of these 4 categories combined. Today, it's only 21%. The multi-asset high equity category, so your max 75% balanced fund, had good growth over the first 5 years, but has practically gone nowhere since. And the multi-asset income category, which is only 10% equity, has been the only category that has grown in relative market share over the last 5 years. If we look at the cumulative net flows over the last decade, it really tells the same story. So the chart on the left shows you the cumulative net flows from the 1st of July 2010 to the end of June 2015. Over this period, the multi-asset high equity category was the clear winner, while the multi-asset income category practically went sideways for a big portion of this period. On the right-hand side, I show you the cumulative net flows over the last 5 years. Here, the multi-asset income category was the clear winner, and actually all 3 of the other categories has had net outflows over the last year. Now, I think a big reason or a big driver behind this de-risking that we've seen over the last 5 years has been relative performance. So on the left-hand side, I show you the annualized return over the first 5 years of the respective categories' averages. And that really is a perfect textbook picture. The higher the equity exposure in the category, the higher the return, and the multi-asset income category delivered the lowest performance. The last 5 years has, however, been a difficult period for domestic growth assets. And if you look at the bars on the right-hand side, it's the complete opposite. So the multi-asset income category has been the top performer, while your pure equity exposure delivered the worst performance over the last 5 years. And I think what then made things even worse, or what made it even more difficult to have that conversation with clients about including equity and including growth, is of course the impact of the global coronavirus crisis. So this chart shows you, with the green shaded area, the global volatility index over the last 20 years. And I just show you what the equity market did with using the MSCI World Index over the same period. And what I find very interesting is just how history shows us time after time that so often when volatility is at its peak, in other words, when it feels like the worst possible time to invest, the market actually delivers a very good performance after that. So with the exception of September 2001, you'll see every time the global volatility index reached more than 45, the subsequent one-year return was double digits. 2020 was no different. We saw the global volatility index reach 83 on the 16th of March. And since then, the equity market is already up 43%. and back to or even higher where it was before the crisis. And this is such a big opportunity cost to clients who panic and who think, oh, this feels terrible, I can't be invested, get me out and get me back into cash. And this really brings me back to what for me is a very important question. Should all clients currently invested in the income space remain invested in the income space? Or are some of these clients in there for the wrong reasons, like chasing short-term performance or panicking about the current market conditions and uncertainty? Now, to answer this question, I actually want to share with you what I learned at my very first photography lesson a few years ago. So I do actually think there's a very high correlation, and it might be quite a useful analogy to use with clients. So when you take a photo with a DSLR camera where you can control your settings, you've got 3 settings to work with. You can control your ISO, which is a sensitivity to light. You can control your aperture, which is how wide the lens will open. And you can control your shutter speed, which is of course how quickly the shutter will open and close. And when you take a photo, irrespective of light conditions, irrespective of weather, these 3 measures have to be in sync. There's a certain relationship that needs to hold between these 3, because if it doesn't, and if it's out of sync, your photo would either be too light or too dark because you're letting too much light or too little light in. So if you change the one setting, you have to compensate for that by one of the other 2 to maintain that relationship and that balance. Now in the investment space, let's call it same trilogy exists with time, risk and return. And it's so important when you have that first conversation with clients or when you do a review of a client's portfolio to always make sure that these 3 are in sync. Just like taking the perfect photo, the relationship between a client's specific time, risk and return needs has to be in sync. It has to be in line in order for the resulting exposure, which in the investment world is asset allocation, to be suitable. So the more time a client has, the more risk or exposure to growth assets the client can afford, and the higher the return the client can expect to achieve. However, if the client's time horizon is shortened, the risk and the return has to also be adjusted. It has to be reduced. Or if a client has a specific increased return requirement, you have to increase the time you stay invested, and you have to increase the growth exposure that you include in the portfolio. And here I show you a very basic chart to just re-emphasize the importance of asset allocation. So on the left-hand side, I very simply illustrate what has the equity market done versus bonds versus cash, and these 3 relative to inflation. Now, if we first look at the equity performance versus the bond performance, it's close to double over this 20-year time period, and the equity market has delivered almost 3 times that of the cash market or the cash index over the last 20 years. But the other very important point and the very important conversation to have with clients when you talk about growth and the inclusion of growth is the purchasing power growth that it offers. And I find a useful but silly analogy to be, what can you afford in terms of, for example, cars? So if we assume we had 2 clients who could both afford a City Golf 20 years ago, client 1 decided, let me invest in equity, and client 2 decided, no, I'm too scared, I want to sit in cash instead. If we fast forward 20 years, the client that invested in equity can most likely now afford something like a Range Rover, or the client that chose to invest in cash can only really upgrade from a City Golf to, let's say, a Polo Vivo. So a really silly analogy, but I think so powerful to just remind clients what the opportunity cost can be if you choose to invest in equity or in cash, if you have the time on your side to invest in equity instead. But I think the very important, most important rule is definitely sticking to the plan. What you can't do is say, yes, I've got a 7-year time horizon, and let's call it change your mind 1 year in. It's so important to, irrespective of market conditions, irrespective of short-term volatility, just remain invested, because the flip side of this brilliant growth that equity offers over the long term is volatility in the short term. So funds with an equity exposure can and will deliver weak and even negative performance over the short term. And by short term, I'm referring to a rolling 1 to 3 year period. What I illustrate on these two tables is the average performance of the 4 CISA categories we're working with, rolled on a monthly basis over the last 20 years on a 1, 3, 5, and 7 year measure. The top table, I illustrate how often are these rolling 1, 3, 5, and 7 year periods positive. On the second table, I show you how often is the return achieved over 1, 3, 5, and 7 years greater than that of money market. And the common theme in both tables is just the massive improvement in likelihood of success the longer you stay invested. So yes, over a 1 year period, funds with equity exposure can deliver negative performance. Yes, over 1 and 3 year periods, there has been many times where an equity investment was worse than a cash investment, but over its appropriate time frame, your likelihood of success is very close to 100%. And then the next question we often get asked when talking about growth is, or equity exposure, is what about clients retiring? How do we manage their portfolios? How do we include equity? Do we include equity? The short answer for me is there's no difference almost. The same investment principles apply when managing a client's retirement portfolio, because remember, it's still a very long time frame. But what I've done here to try and illustrate the role of growth even in clients already in living annuity is I used the Nedgroup Investments Big Picture app, which feeds off monthly market data since 1926. And I looked at 3 scenarios. I said, let's assume we have a client retiring with 3 million Rand, and this client is planning either for 20 years, 25 years, or 30 years. The other thing that I looked at is what's the impact of the drawdown rate. So I looked at the impact of the client's success when he draws 4%, which is a starting monthly salary of 10,000 Rand, all the way up to a drawdown rate of 9%, which is a starting salary of 22,500 Rand. I then use the Big Picture app to calculate the likelihood of success. In other words, how likely is it that your 3 million Rand will last for your retirement when you invest in income, low equity, high equity, or pure equity funds. The asset allocations in these funds are, let's call it standard or average exposure of those categories, subject to the limits of the CISA category. And there's a few things that I want to highlight here. I think first and foremost, what's very clear is as you move from income to low equity, high equity, and equity, in other words, as you move up the risk spectrum, the client's likelihood of success at a 4 and 5% drawdown rate is very good. So if you look at the right-hand side of the tables, a client drawing 4, 5, or even 6% invested in a multi-asset high equity type solution has a pretty good chance of having a successful retirement. The 2 things that materially detract from success is the exposure to income or the lack of exposure to growth assets throughout this 20, 25, or 30-year period. You'll see that clearly with the likelihood of success dropping all the way to 0% actually when the drawdown rate increases. And then the other big detractor is, of course, the drawdown rate. I think one of the biggest differences clients can make in retirement to their success is being as frugal as possible with their money and managing the drawdown rate as tightly as possible. And just to wrap up, I want to just reiterate some of the key points I made in today's presentation. I think firstly, the basic investment principles are true and should be used for portfolio construction irrespective of market conditions. And for that, I think the time frame is is definitely the starting point. So it needs to be a key driver of the resulting asset allocation for a client's portfolio. That asset allocation will then always be the key driver of the short-term volatility and the long-term growth a client can expect. Emotional reactions can be extremely detrimental to a client's portfolio. The opportunity cost can be significant. And as we've seen in the past, so often when the temptation to switch is at its highest, the timing to switch out of equity into cash is probably at its worst. So managing that emotions in times of panic is such a critical value add for the financial planner. And then I think maybe just to summarize the answer to my question, to my discussion today, or my topic, is growth assets like equity really play such an important role, both pre and post retirement, but I would say with the disclaimer that it's included for the right time frame and that a client sticks to that investment plan. Thank you, Trevor. I hand back to you.
Great. Thank you so much, Sine. That was very informative. And the good news for you is that I think you're going to get off one or two questions just for us to keep on the time track. But I think the message that you gave is absolutely vital, and really, yeah, if the role as a wealth manager, as a financial advisor, I think the biggest value that you can add is really managing your clients' emotions, managing their investment behavior, and in that way, you can make a massive difference on their ultimate investment performance. I thought a couple of little pieces of information. We've got just under 400 people on the webinar today, which is amazing. So thank you everybody for dialing in. It's pouring with rain here in the Atlantic seaboard of Cape Town and freezing cold. So I'm not sure the weather throughout the country, but our dams are certainly getting close to, I think, 100% full. And lastly, I see the Rand has weakened by about 10 cents since the webinar started. So I'm guessing investors were listening to Nicky's presentation. All right, so next on the speaker list is Iain Power, who's Chief Investment Officer at Truffle Asset Management. Iain manages the Nedgroup Balanced and Nedgroup Managed Fund, which is one of the funds that we hold within one of our multi-manager ranges. And Iain is really going to give us a short presentation specifically on the South African environment, with a focus really on the retail sector. So Iain, I hand over to you.
Morning everyone, and thanks Trevor, and coming to you from a cold Johannesburg and a little bit wet as well. I think, you know, the backdrop that we've all heard this morning, and I think nicely sketched from Trevor's opening and specifically Nicky mentioning, you know, what are some of the key deliverables that government needs to, I guess, really show us to change this environment is illustrated well in looking at the retail market and the retail sector, which has really been at the epicenter of the crisis. But I guess more importantly, what I'm going to show you is when we take a step back, is a lot of these problems have been entrenched for quite some time, and you know, without seeing evidence of this change, I guess one needs to be circumspect in terms of you know, how we look at some of these assets. But if we get into the presentation, just going on to the first slide. The first slide just really demonstrating that the dislocation of the South African economy to the rest of the world, and we're showing here a slide of the median country GDP per capita growth versus South Africa. And what you can see is there was a very nice tight fit going back to the early 90s in terms of the South African economic output per capita versus the rest of the world. Yes, we had a little bit more volatility, and that's because we are an emerging market, but you can see by and large we would come back to the trend and deliver per capita growth in line with the median country. And you can see with the inception of the Zuma era, there was this dislocation and this ever widening gap to the extent that if you look at the lighter green line, you can see that on a per capita basis, South Africa or South Africans have been getting poorer for the last couple of years. And I think that talks really to the crux of what Nicky was saying in terms of some of these structural changes and reforms, together with the fact that under the Zuma era, we have almost or more than doubled our debt to GDP over 10 years, and yet we have nothing to show for it. We have power stations that don't work and trains that don't fit the tracks. So, I think this is an important slide, first of all, to really sum up the economic backdrop from a South African perspective. And it's important because the retailers and SA-focused businesses need to earn their earnings in this underlying environment. So Nicky also mentioned the extraordinary rents that South African corporates and consumers are having to pay because of moribund and effectively non-going concern SOEs. You've heard about Eskom, and I think here, just take a look at the graph going back to 1987 and showing you our Eskom tariff increases versus CPI. And you can see the extent to which the South African price increases for electricity were actually below CPI. And we had a very stable and powerful network in that period, which delivered reliable service and reliable electricity at a very competitive price. And this would have encouraged businesses, which electricity forms a big portion of their cost base, to invest in South Africa. And that's exactly what we saw with the likes of BHP Billiton and many businesses investing in electricity intensive businesses. But you can see the change from 2007, 2008 to the extent of the underinvestment and the lack of maintenance on these facilities. And you can see the extent to which now we've had almost 450% tariff increases over that period, where inflation is only up about 100%. And we know that each of us listening today, we all have to pay our electricity bills, and we certainly don't recoup that in terms of wage increases to the similar extent. So I mean, I don't get a more than a 4% salary increase, yet when I'm faced with rates, water, electricity continually going up more than inflation, that takes a bite out of our disposable income. And it's exactly the same for SA corporates. So if you can imagine, SA corporates have become less competitive over the last 10 years as a consequence of not investing in our productive assets or capital, which ultimately, if we were a company, South Africa is becoming less competitive versus other global countries. So what about valuations? And I think Seugnet touched on some good points in her presentation. And I think she said a few things which I think are important to keep in the back of our minds, is that often the best value will come at the darkest time. And I think if we take a look at this slide, which is really showing you the apparel retail sector valuations versus their long-term median, and I've used a 2-year forward PE because earnings have collapsed currently in the retail market, and there is a recovery in terms of the 2-year forward consensus that is built in. And I think if you look at this slide, what you can see is that optically, relative to the history, current multiples are looking cheap versus the long-term median. So on a superficial basis, I think, what this graph means is that you're paying a discount for a unit of apparel retail industry to the extent that, if one looks back at the history, you were perhaps paying a 13 times multiple, whereas you can buy into that today at around about a 10 times on a 2-year forward. So that, looks interesting, and certainly you would be perking up your ears and thinking, are there bargains to be had in this environment? Now, what is also interesting is over that same 10-year period, if you look at the returns on invested capital of the industry, they have in fact halved over that same period. Now, these returns have declined for various reasons, but the reasons would include the lower growth backdrop top, which I think you've seen as evidenced by our dislocation from the rest of the world. And then the fact of the matter is that SA businesses, like consumers, have been facing big increases in the administered prices in terms of their underlying businesses, which they haven't been able to recoup. So their margins have come under pressure, their asset turns have come under pressure, and many of these businesses, in an attempt to escape a declining and low growth SA environment, then turned to offshore markets and promptly got some bloody noses, to the extent that they bought assets overseas which have been disastrous for shareholders. So whether it be Truworths buying Office and effectively writing off 30% of their market cap, or Woolies buying a dinosaur in the likes of David Jones, it has not turned out well for SA retailers who have typically gone offshore in search of better markets. So from a sales point of view, I thought this slide is quite a nice one, because it shows you how over a long period of time, even though the series is volatile, RS South African clothing retail sales, what you can see is there's a very distinct trend that typically in the 2010, 2011, those first 3 years, you can see that the average retailer was generating sales growth of almost double digits and sometimes double digits. But as the handcuffs that have been imposed on our economy because of the lack of structural reform, the extraordinary rents that taxpayers have had to pay to fund bankrupt or non-going concern state-owned enterprises, you've slowly seen investor confidence, consumer confidence sap away, and a low growth environment results in lower amount of money being circulated in the economy, which ultimately manifests in lower sales. So you can see how this series effectively is now amortized all the way down pretty close to zero. And I think the problem with this is that when you are a company and you are facing electricity price increases this year through your landlords of 15 to 17%, if you're a mine, if you're a manufacturer, and your labor increase costs are going up at 4 to 6%, yet there's no growth in the economy, it means your margins are coming under increasing pressure. And ultimately, then you have to start looking at your cost base. And I think if we look at the cost base as one of the series that for us was very, very interesting to observe is if you look at the OPEX to sales ratio. So this is the operational expenditure in businesses as a percentage of sales. And what you can see is how those ratios have risen over the last 10 years. So the underlying costs in the business have been rising at a faster rate than what sales have, which puts pressure on margins and ultimately results in less profits for shareholders. So it's no surprise to us at Truffle that we've seen a lot of the price destruction even prior to COVID in many of the retail sector because of what you've been seeing in the SA economy. Now, that's all history, and it's looking in the rearview mirror. And as Seugnet said, often you can get the best bargains at the darkest hour. And I think there's no doubt that superficially the valuations today of many of these businesses are much cheaper than they were. But the question is there really a mean reversion opportunity to the extent that profits can then mean revert, margins can rise, and you get a commensurate rise in PEs. And I think for that to happen, you need certain things to change in the economy, which I think Nicky has already alluded to. If one looks at the food retail sector, it's been a lot more defensive, but is still under a lot of pressure. And I think what is interesting here is if you just look at the 3-year estimated earnings growth numbers that we've got for the next 3 years, you can see these are, at best, slightly higher than inflation on average. And very importantly, you can see how those 3-year forward-looking ROEs have also come down. So, effectively, when you're looking for bargains, you would be wanting to buy into these businesses at attractive prices. And when we look at their forward multiples, the current forward multiples versus the 5-year averages certainly don't look compelling, with the exception of Woolies, which does look interesting. And generally, we would say that food retail does not look cheap optically compared to the apparel retailers, which do. But we think that you're going to need economic certainty. We think you're going to need policy reform before you get investor consumer sentiment returning to the extent that you can then see this value opportunity being unlocked. So whilst optically, the apparel retailers and, Woolies might look cheap, it's going to be difficult to unlock that value when you are not seeing a normal cyclical recovery in the SA economy like we would have seen in previous cycles. What is interesting when you look at the SA investable universe, if we just look at the all share and look at the makeup of the all share, and what we've done is we've taken the SA focused businesses which are highlighted in red, and you can see almost 20 years ago they were almost 70% of the market, and today they sit at just under 40%. So many of the bigger businesses which have continued to grow and which either just happen to be listed in South Africa or generate their earnings by exporting are enjoying the benefits of that better, more robust global growth environment, whereas South Africa has been shackled by all the factors that we have spoken about. So in essence, yes, there certainly might be some opportunities in that red space, but we're going to need the economic conditions to improve, and we need the state to take the lead in terms of reform to take that backdrop. So I think on this slide, in terms of decisive action, I think Nicky covered it quite nicely, and really highlighting the fact that we need decisive intervention. And with that intervention will come the keys to unlock the handcuffs on what optically does look like some interesting valuations in some of the SA shares. But if that doesn't happen, they may well just turn out to be the value traps that they've been for the last couple of years. So to summarize, I think it's fair to say that the economic backdrop is going to remain tough. At Truffle, we are data dependent. We continue to observe the data and look for changes which might give us a lead in terms of whether the backdrop is going to get better. I think I've given you an illustration of in the apparel sector, and banks would be another sector where we can say optically valuations look cheap, but it is in inverted commas. And it's in inverted commas because the mean reversion opportunity is going to be a function of the earnings recovery potential. And I think that's where all the question marks are, as you've heard echoed by Nicky's introduction insofar as that backdrop. And I think ultimately the earnings recovery that we see from SA corporates is going to be a function of the structural reform and the extent to which there is political appetite and capital to do that. And if that happens, there could be a fantastic opportunity in some of these SA-focused assets. But until we see that, the mere fact that PEs are lower, we don't think is enough for us to get really excited about allocating significant higher proportions of capital to those shares, because they may just end up being value traps like they have been for the last couple of years. So, in a much lower growth environment with lower returns, PEs need to be lower. If banks can't cover their cost of equity and their WACC, they will trade at discounts to their book value. So unless you can see ROEs getting above cost of equity, some of the banks will not trade at premiums to their NAVs again. And I think that's really the crux of the matter. Now, having said that, there are absolutely opportunities across all the sectors. So it is very much a stock pickers market. And, at Truffle, we feel that we think volatility is going to remain high because of the uncertainty. But what is good is that volatility creates opportunities for managers which are nimble and able to allocate capital quickly to shares which get sold down below their intrinsic value. So hopefully that gives you some sort of sense insofar as how we are seeing the SA-focused businesses and some of the challenges that they're facing. and some of the factors that we're looking for, which would give us more confidence to be able to allocate more capital to some of these businesses. Thanks.
Iain, thank you so much for that. Very interesting. Certainly, I guess from my personal side, I've been trying my hardest to keep Woolworths and Spar food sales up during the crisis. Can I just ask you, you're not going to get totally off it, a very short reply though, because we're just trying to keep on track. And you did touch on it on the banking financial stocks, but can you just give like in a minute what you see, what your Truffle's position is in terms of banking stocks, financial services stocks, and I'm guessing the catalyst for those to also reprice is very much the same catalysts that you'll need for the retail sector. But can you just give a very quick answer just on how you guys see the banking stocks?
No, that's right, Trevor. And I think banks, like the apparel retailers, certainly don't look expensively priced. So whether we look at banks on a price to book basis, on a PE basis, they look very cheap relative to the assets and the loans that they have on their books. But the uncertainty is that if we are in an economy which is going to remain shackled and does not or is unable to grow, it is going to be hard for SA businesses to generate enough revenue growth to offset those cost pressures which are coming through the system. So I think that in essence really is what we're talking about. So we do hold some of the financials where we think, some of the bigger franchises, they are bigger businesses, they're going to be able to withstand these difficult times, and they are going to be able to cut costs. And I think that's a point that you touched on and Nicky touched on, is we're going to see corporates aggressively target their cost basis to protect their margins, but ultimately that doesn't help the economy because it just creates higher unemployment. So it gets back to what Nicky was saying, is we need to see some decisive structural reform, which will really create a backdrop to unlock some of the value that optically is apparent in some of these assets.
Great, Iain, thank you. That's, I think, sets the scene well. Thanks, Iain, very much for your time and comments and insights, and also, for the great job that Truffle are doing in terms of managing the managed and balanced fund. So keep up the good work, and you're welcome to obviously listen in to the rest of the webinar. So now moving on to our next presenter, I think, one of the big things that we've faced in terms of COVID, Corona, the last 6 months, and this has been a global characteristic, is the shutdown that we saw of the economies and specifically of our schools. And I think different countries have tackled this problem a bit differently. Certainly when I watch CNN and President Trump, it's becoming quite a political thing in the States, him trying to push the schools to open, some of the states pushing back to say the virus is still, a risk problem. And this is certainly a debate that's also I've experienced around the dinner table many times over the last month or two, parents debating the pros and cons of schools opening and closed. On top of that, I think one's also got to be very aware that there are different types of schools in South Africa, your wealthier ones and you're not so wealthy, and the wealthy kids have benefited by Zoom classes, etc. But nobody else better to give a view on this. So we have Professor Piet Naudé from the Stellenbosch Business School. He's also director of the school, professor of ethics, and a previous presenter at some of our Nedgroup conventions. And we've asked him to just give his views on the schooling system, opening up of the schools from a moral and ethical perspective as well. So, Professor Piet Naudé, I'll hand over to you.
Hi, thank you, Trevor. Can you all hear me? Is everything fine from my side? Yeah, thank you very much. And you can see I chose a very specific backdrop, the playful kind of children at school, I hope. And firstly, thank you to Nabila Ghani for assisting me to get onto this very complicated system. I must say, we do teaching online and our systems are a little bit easier, but I'm on and I'm very happy to be here. Well, 15 minutes, I'll use about 10, 11, Trevor, to just give a very sharp view on this. Firstly, let me say, to link up to our president, the third virus in our country is the failing and ineffective and low quality school education system that we've built since 1994. We've got the data to show that we are failing generations upon generation of school leavers with giving them an inadequate, an inappropriate and a low quality education. The data is there for all to see. If you look at all the data around our literacy and numeracy levels compared to the rest of the world, South Africa really has its head to hang in shame. The fact that we don't see the immediate economic impact of that, like when you close down sales of alcohol, doesn't mean that it's not a virus that is slowly infecting the social and economic fabric of our country. Firstly, then, to say there are 14.2 million learners in South Africa in about 24,000 public schools of various forms, and about 2,500 of those are independent schools. Not all of them rich, but mostly they are. So the decision to close down schools affects, Trevor, a very high proportion of the population. 14.2 million children, add in their parents, add in the teachers, add in the support staff in the schools, add in the grandparents, and we talk here about a decision in a population of 59 million, are probably around half of the population affected. So it is a huge disruptor and a very important decision to take. So what happened? On 27th of March, when our country realized that the coronavirus reached us from Europe, probably from a ski resort in Italy, and we saw the infection rate rises, our president, I think rightly so, locked down the country completely under what we call level 5. At that point, it was perfectly justified. And the reason I say that is we were not sure of how quickly the virus would spread, where the hotspots would be, what South Africa's pattern of mortality rates would be, what our survival rates would be compared to the rest of the world. And very importantly, Trevor, on the 27th of March, we had no good medical data to tell us whether age plays an important role in the spread of the virus or not. So at that point, I think it was a valid decision. We had to find the data on the basis of which to take these decisions. And in this time, to make it very short, Trevor, we have 3 ethical obligations as a state towards the school system, whether public or private. Firstly, we have, in terms of the Constitution, the protection of life and the protection of vulnerable people. And remember, children are not adults. They are legally not able to take their own decisions. We decide for them. In all research and ethics, they would simply be seen as a vulnerable group, and therefore one has to be very careful when you take a decision on their behalf. So what happened after that? We got the data. And Prof. Glenda Gray, which is, by the way, the CEO of the South African Medical Research Council, she's also a pediatrician studying child health and herself a parent. What came to the fore after a few months, that children and youth is quite resilient to the virus infection, and according to the data that we have for past years, they are more likely to catch the common flu than to be infected with the coronavirus. The second thing that we found was, where does infections happen? And we found that if one puts in place basic preventative measures in the school, testing, mask, and so forth, which is not rocket science, schools are actually extremely low transmission sites. You're far more likely to attract the virus in a 100% full taxi, in a shopping mall, or in a club, or in a sporting team. So by the time we reach lockdown level 4 and 3, we already knew, if we want to take our ethical decisions on good data, that schools are actually, relatively speaking, obviously subject to basic precautionary measures, safer spaces than many other places in society. And when we look at the average child in our South African schools, most of them would be safer in a school than in a home. And that is the first part. So if we say our first ethical obligation is to take a decision for vulnerable people and protecting their lives, I think reopening schools in whatever way, I'll come to that a bit later, would be fully justified based on the data that we had a little bit later in the virus history of South Africa. The second ethical duty, and the Constitution is clear, you can protect life, but it can be a miserable life. So we talk about first order right to life, but we also talk about second order rights, socio-economic rights, educational rights, the right to certain basic services in society. And there I think one has to take into account that up to last week, on average, we've lost between 6 and 12 weeks of school days, depending on the grade that the child would be in. And we know from data that the longer children do not actually attend school, the less likely it is that some of them will in the end return. And the reason why I say that is the dropout data of children beyond the age of 60, specifically boys, are extremely high in South Africa. They become a huge burden in society because they've not even passed matric. Their chances to enter the economy is very low, and it becomes a huge burden in the longer term socially and both economically. So if you lock down schools, you must keep in mind the context of our education system, and that is, will people and pupils return to the school after a while? And by the way, if you close it over this time with no education in between, you simply reinforce the third virus that has been coming for a long time. Low quality and a very inefficient system in terms of throughput. And I think that is ethically totally unacceptable. A second issue around the quality of life, Trevor, is schools are for many children a very important social development spaces. Remember, we that sit in this webinar are part of the 2% high earners in South Africa. We privileged people. When we think of a school, you know, we think of the kind of private Model C school environment, and we think of lockdown, we think of a house with a TV, with a swimming pool. Let us not forget that for many young children who are locked up in whatever home environment would be, that is not an environment conducive to good social and personal development. I don't have South African data, Trevor, but we do have preliminary data from other countries that there's a significant increase in asocial behavior and maladaptation and even mental health amongst children that are locked out of the social system of a school over a long period of time. That, I think, in South Africa is a crucial point, and I think we need to think very carefully about the social development implications of a total lockdown of the schools. And then the third aspect about the quality of life is a question of simply you have to eat. And we know that 50% of South Africans roughly are seen as poor. We know how many of our social grants are actually paid to support children, 18 million per month, about of which 11 million will go to children. I think a fantastic effort of our country to provide a kind of social safety net. But schools are also places of food security for many children. If you lock them simply down and you don't replace the food system, we already have the data from our dietitians that the stunting of our children between the ages of 5 and now 9 is totally unacceptable. So the big second ethical argument for opening schools is the second order socio-economic rights of social development, the right to basic education and food security. Lastly, that's my third point, Trevor, is the ethical duty to relevant education. The big problem with South Africa's education system and why it's failing us, it is inappropriate for our economy. Any good education system in countries that have successful education systems have a very small so-called academic school component and a very large technical vocational schooling system. You can go to Germany, you can go to Singapore and those places. We have a completely wrongly structured a school education system. And by the way, I'm in a university. We also have far too many universities and far too few TVE colleges. We only have 50 public TVET colleges and 26 public universities. There should be 200 TVET colleges. And in my view, I know it is controversial. I don't think South Africa needs more than about 10 to 11 good universities. So what the virus did was, Trevor, it provided us with a unique opportunity to turn the so-called fourth industrial revolution technical-based education into reality. Now, let me give you the facts. Only 40.9% of public schools, the figure is from 2016, it might be slightly higher now, only 40.9% of public schools have access to computers for their learners. 60% don't have it. If you lock the schools down, you have a fantastic opportunity to turn that whole situation around and make sure that the data capabilities, the digital capabilities of our children is enhanced. But there is an opportunity. According to Statistics South Africa, 75.9% of households in South Africa have access to a mobile device that would enable the possibility of learning. So instead of running around and buying, 200,000, and amongst that there's crooks in them, that steal our money, laptops for everybody, we could have done a very simple transition to mobile learning. We've done it in business schools, we've done it in universities, it can be done. So I conclude. I think the closure of schools at the beginning was the right decision, simply because we didn't have the medical data, we didn't understand the virus. Beyond a certain point, I think I can find no ethical justification to close the schools on a permanent basis in a physical sense, obviously on the condition that you manage the risk in a proper way. It does provide us with a fantastic opportunity to turn our learning much more into online, virtual and mobile learning. And then I end off. We know that our government during the coronavirus time claimed to take their decisions based on the best available data. We also know that that is not true. They take their decision partially based on data, but also based on lobby groups, whether it's taxi owners or in this case SATU, the very strong trade union within the education system. And I do believe that there's an incentive for lobbying the opening of the schools, because public schools teachers get their salaries every month, whether they sit at home or whether they go to school. So in a way, you've got a disincentive to reopen the schools. Not for everybody, I don't want to blame them, I simply make a statement of human nature. If you have an incentive not to work, why would you work? So my solution is we must immediately declare all teachers as essential services. They would not have constitutionally the right to strike because they provide an essential service. We must provide them with adequate protective gears, as we do for our medical staff, and they need to go back to the schools. Thanks very much.
Great. Thank you, Piet. I do have just one question for you, and you touched on it a little bit. There's definitely been this move towards, let's call it, internet-based schooling now, and we see certain businesses popping up globally, but certainly also in South Africa. 2 points to that for your views, please. The one is, do you think as a child you can get the same learning experience sitting at home and being taught, over the Zoom or Teams or whatever it might be, but over the internet? And then touching on your point that you made on the vocational part of it, I guess, being in a science lab or being in a woodwork room. I mean, certainly that you can't do at all, I think, via internet sitting at home. So can you perhaps just give your comments on those 2 points?
Yeah, Trevor, very easy. The first one is, as technology has advanced, we are in fact able to replicate very high quality learning experiences online. We do that in the business school in Stellenbosch University. We spend about 150 million rand in 3 weeks to turn our whole system onto a digital learning experience, but you must be retrained to do that. It's not just, you go online and show your PowerPoints like we do here. It is really about making sure that the learning experience and also learning from one another. Yes, it is possible, and you can also do that through mobile devices. Your second question is, can you do everything that way? No. there are certain practical skills that you need to do, and obviously that would require a different setting. But more importantly, the isolation that arises from digital learning is a very serious issue. Although there is something like virtual sociality, research is not yet convincing to show that it replaces the idea of a social face-to-face interaction with other people. There is a limit to what we call the social power of the virtual world.
Great, very interesting. Well, thanks very much for that. It's certainly much food for thought there, and for certainly talking for myself, you raised a few points that I hadn't really thought much about, even having had many conversations on it. So thank you for your time, for the effort you put in there, and we appreciate it, and much food for thought. I'd like to say a big thank you, just very briefly, to remind everybody that tomorrow afternoon at 4 o'clock, there is a Take 5 Meyer Fisher French on retirement seminar that's going to be available for people to webinar into. So please don't forget about that if you're interested. And lastly, for those of you who haven't registered for our monthly report called Pulse, we've got over 1,000 subscribers already, but please go to the Nedgroup website and just into the financial planner section and register to get the next Pulse that will be coming out next week, actually. So I'd like to end off by thanking everybody. I hope you found the last hour and 40 minutes or so informative, helpful, and we look forward to welcoming you all back in early December for our third and final webinar for the year. Thanks, everybody.